Now it gives me great pleasure to welcome James Henderson.
Thank you very much, Mark. And I will be talking about Henderson Opportunities Trust, which is the smallest trust that Laura, Fole and I run. Our largest is Lord Debenture. Then we run one called Lowland, which is an income fund. And then this one, Henderson Opportunities Trust, where we are different to other funds, where it's a very different sort of portfolio. We concentrate on things that make it a real mixer in people's portfolios. So for holders, we don't see this as a one-stop shop. This shouldn't be your only equity holding, but it can give really good returns and should give really good returns, because we're finding things in the market that aren't being generally seeing much attention being paid to. This has led us to do more in AIM of late, and now as we talk about it, 40%, around 40% of the portfolio is in AIM stocks. These are under-researched at the moment. They aren't popular with investors, and this is really giving the opportunity. We are seeing a bit of value realization in the area of late because there's been takeover activity, reminding people of the value that is down there. We're going to go through some of the stocks that are really exciting me during this webinar. But it is to remember it's about balance. So we have got big companies. They are the ballast to the portfolio. We'll be reducing them when we see the opportunities in small cap. And we've gone quite a long way to reducing that and buying the AIM stocks of late. There is a very professional board, a very good board of HOT that understand what we're trying to do. There is a the chairman has said that the dividend will be grown over time, and it has been grown, and that's all in place, and we can use the investment trust structure to ensure that that growth comes through. So let's get into the presentation. I'll just give a short update of where we are. That we're trying to smooth the volatility of what's happened in small companies by using the big companies. We've actually failed often to do that. The moves have been so extreme in smaller companies, particularly in AIM, which are so out of favour at the moment, that that we haven't had enough sometimes in the big companies. But it's been the big companies that have been helping us of late. We believe that in time the smaller companies are going to come through strongly. We may be seeing the start of that. If we could just see the next slide, please. See where is it starting after a very difficult period for HOT over the last 6 months, the end of April. You'll see the NAV is up 18.6%, which is ahead of the all share at 14.2. We're beginning to see the recovery coming through. The dividend at the interim stage was held, but as I say, over time it will be grown. Next slide. This just shows how the portfolio is currently balanced. As I said, it's about large, medium and small companies, with the real differentiator being that 40%, that 39.9% you see at the bottom in AIM companies. These are companies that many investors perhaps haven't heard of, and that's the value add that HOT can do. We're going through those companies, we're paying attention to them, we're finding the opportunities there. The companies in the FTSE and the 250 you'll have heard of. We spend time thinking about them, obviously, and we are always trying to add value in that area, but the differentiator is AIM, and that is what will determine where the fund, how the fund performs over the medium and long term. That'll be the real differentiator. Over the period in question, it's been actually, for all that, it's been the bigger stocks, some of the bigger recovery stocks that help that performance. You can see that in the portfolio there's been Marks and Spencer's, Rolls-Royce, Kia and Babcock. Both in Marks and Sparks and Rolls-Royce, there's been a genuine recovery. That recovery was inspired by management looking hard at themselves and thinking what their real, as a companies, what they were really trying to do, getting out of some peripheral businesses and focusing on their cash generation and real raison d'etre for as companies. And this has seen a really real operational recovery in Marks and Spencer's and a real return to cash generation and profit growth at Rolls-Royce. Rolls-Royce was always a great company. It's changed the way it prices its product. It's looked at its costs hard, and yet the technology has always been good, and that is now coming through. Very different is Kier. Kier is the contracting company building much of the needed infrastructure in the UK at the moment. The whole area has been very difficult in recent years with contractors, but Kier, with a management team that's highly professional, that is pricing contracts correctly, has come through that and is now on a very strong profits momentum, and that has inspired the share price. But with Babcock, again, it's a management story. The hard look at itself, again, now back on a recovery track. So those are the things that have really been going right over the last 6 months for HOT. What's been going wrong has been selective smaller companies, most notably Zoo Digital. Zoo has suffered from it. It does dubbing for the big studios, and it suffered from the writers and the actors strike last year. And we still haven't seen production go back to the levels it was. So after some soul searching from me and Laura, we've admitted our mistake and we sold the position. The others that have been weak are some of the smaller oil stocks, particularly ones associated with the North Sea. The reason being that the windfall tax calls into question some of the projects. But these stocks, if the North Sea keeps is got a role to play in the British economy, which we would argue it has, these stocks are very cheap. They're very underowned, and the area has thrown up. You can buy oil in the ground at extraordinarily low prices. Though I'm the first to say we shouldn't have been there in recent times. We think these stocks will come through. There are good bits in there that will still be producing in years to come and earning with earnings that come through. But some of them need to really recover. The belief that the windfall tax will be there, but that you will be able to offset some of that windfall tax with capital allowances, and that's a question that we don't yet know from the Labour government exactly where those companies stand on that. But it's a diverse long list. We'll always have areas that will need to see some recovery, and it's in those recovery stocks that we'll often get the best returns, as we have of late with the likes of Rolls-Royce and Marks and Spencer's. Next slide, please. So this just goes through the NAV of late and the longer term. The area has suffered in small cap over 3 and 5 years, but that is pent up outperformance for the future, in my view, and we have increased the positions there to position ourselves for that. Next slide, please. What you see from Henderson's Opportunities performance over the years has been a volatility. There has been volatility, as there has been from the index, but it's been greater from Henderson's Opportunities. That's because of the smaller company mix. We are running with a long list. We have got large company exposures, but we are reducing those when we see the value and the opportunity in AIM. Coming out of difficult periods, we have had very strong years. 2012 was a difficult year, so 2013 was an up 45% year. We had a very poor time in 2022 because after COVID, some of the small companies ran up very sharply. As you can see in 2020, after COVID, that year the NAV was up 14, whilst the market was down 9. We lost some of that. We should have we should have taken more profits in 21, because 22, some of those companies come back sharply. We're now on a, as seen by the last 6 months number, on a recovery tack in some of those smaller companies. But let's talk about the portfolio. Next slide, please. Next slide, please. So we are a mix of early stage companies, growth small companies, quality small companies, recovery and special sit stocks. Those are what they would term all those as tomorrow's leaders. They're going to be, some of them are going to be the substantial companies of tomorrow. We balance that by having these large cap stocks and companies that are in natural resource area, have the natural resource stocks, because they're on a different cycle to the small companies. When the oil price goes up, it's often bad for small companies, but at least this part of the portfolio will be going well. Let's go into what happens in these different areas of the portfolio. Next slide, please. This is the current mix. Some early stage companies are at 7%. These are often pre-revenue companies or just starting to make money. 7% of the portfolio, and in here, these stocks will be companies that should emerge and go through and become the small cap growth stocks, and hopefully some of them in time will become large cap stocks. These are the long-term holds. Some of these companies at the moment are in the alternative energy space. This is hydrogen companies, fuel cell companies. There will be a lot of work in that area, and some of them, when they get their technologies right, will be substantially bigger companies over time. The small cap growth are quality small cap companies, whilst the compounders are companies that might not have stellar growth but have come through it year after year. The recovery stocks we've talked about, they're the Marks and Sparkses. The Marks and Sparks is moving out of that into large cap growth. And then resource stocks are the oil companies and raw material companies. Let's talk about what's in these different buckets now. Next slide, please. So Creo Medical is an early stage company. This is making medical devices so that you can have surgery in a non-invasive way. They come through your vein to where they're operating on you rather than cutting the patient open. This company is really gaining some traction. Doctors are beginning to use their machine, their kit, and it is seeing a take up. But at the moment, there isn't a lot of attention being paid to this type of company in the market, as people are genuinely quite nervous. It's given us an opportunity, and we have increased the holding in Creo of late. This is that part of the portfolio, tomorrow's leaders, 7% in early stage companies, and Creo would be 1% of that, of the portfolio, a seventh of that bucket of early stage companies. Next slide, please. Morgan's is different. Morgan's is a very old established company in really tidy niches in the advanced material space. It's got a management team that is really now pushing it forward, but investors are still thinking about the past and the problems that they've had in the past, not in the strengths the company now has. It's got out of certain areas, it's focusing on its core business, and it is back on a growth trajectory. The valuation is very low. I've followed this company a long time. You've not been able to buy it at this kind of rating before, yet the prospects are better than they have been for a while. It's the kind of company with a bit more top line growth. We'll see operating margins open up because it's got its costs well under control, a little bit more on the sales line, and we will see those operating margins grow further from where they are today. That's not factored into the share price, it's not factored into earnings forecasts. Next slide, please. STV is a more conventional recovery stock in that as advertising returns, this is Scottish TV, as advertising returns, people and the economy begins to recover a bit, the advertising pickup will lead to STV's earnings moving forward. At the moment, the valuation is very low. It's got a business that's just beginning to see the return of the big advertisers stepping up, and it is seeing upgrades. It's got also, besides the conventional business, it's also got a big successful production business, which brings some balance to the overall mix. Valuation here for this type of business is usually relatively low. It's exceptionally low at the moment, yet growth is coming through. Next slide, please. These are the kind of long-term stabilizers. So where will we will be a net buyer in the smaller companies area. If there's further sell-off on name, we will buy a bit more stock. We will finance it by selling some of the stabilizers. GlaxoSmithKline is in a good place operationally at the moment. It is growing modestly. It's a sound long-term investment, but it will be a source of cash for us going forward when we see the opportunities in the medium and smaller companies. Next slide, please. So we talked about the stabilizers in the portfolio. We have this stocks in the natural resources where they are on a different cycle. We've got a mixture of large, medium, and small companies within the stabilizers. So Jersey Oil and Gas is in the natural resource stock area. It very, very cheap if it gets the go ahead for the Buchan field. Whilst also in the natural resource area, we've got some of the big boys, the Rios, which will benefit from things like copper price going better. So what I'm trying to get across is the diversity of the portfolio. We've got about 90 stocks in there. They're all, we believe in all of them as long-term growth businesses. But they've all got different characteristics, and it's that diversity that gives protection over time. And it's also the belief that there is genuine growth in these underlying companies that will drive the NAV over time. Next slide, please. Here is some of the recent additions to the portfolio. Again, trying to get across the diversity in it. AFC is a hydrogen fuel cell company. It's got just had a tie-up with Speedy Hire, so you'll be able to people in construction will be renting the fuel cells. This will be replacing the traditional diesel genset. And the energy from a fuel cell at the moment, it would be more expensive than a diesel generator. However, there are contracts now from councils and things that are saying, please, you only get this contract if you don't use fossil fuel. Therefore, that is giving AFC an opportunity, and as they produce more fuel cells, as they get better and the production line gets more slick, the price of the fuel cell will come down and will in time compete with more conventional energy. These companies do need help in their early stage from the way people, councils or people that want to move away from fossil fuels, putting business their way. But in time, those costs will come down. Something totally different that we're buying recently has been Workspace. This is flexible office space. They are repurposing buildings that have become redundant and tired. They turn their use into what people are now requiring. Sometimes it is tech businesses that are coming into their old offices. Sometimes it's becoming light industrial. It repurposes and revamps those buildings and gets rent up over time. That's in property, what we're looking for is management teams that can add value with the assets that they've got. We're not just relying on those assets revaluing. You've got to, as a management team, be adding something to create some goodwill in that share price. Marshalls recently been increased over the last year. We've been increasing the Marshalls holding. It is the premier building materials company in the UK. Wonderful asset base, really good products, and as we're seeing it pick up in contracting and construction, in home build, Marshalls will benefit. It is cyclical, but we're at the right stage of that cycle. Then something completely different. One of the bit of the ballast in the portfolio would be Flutter Entertainment. This is Betfair, Ladbrokes. This is the gambling company, growing really fast in the States at the moment as deregulation happens in the US of the restrictions that they've had on gambling. So they're large, medium, and small companies, but all of them will, we believe, be growing over the next period. Next slide, please. So this is the current portfolio, top 10 holdings. Obviously, Barclays and Rolls-Royce have been good of late, and we are reducing both Barclays and Rolls-Royce a bit after the strength we've seen it in it. Boku is a really interesting small company. It's the kind of name that perhaps people don't know, and it's what we specialize in. Boku is a payments on your mobile phone, and it's signing up a lot of the very big companies around the world like Spotify. Also Amazon are using Boku for settlements in the particularly in the developing world. Some places in the developing world, they're going from cash economies straight to using the phone for settling bills and paying for the things. They're not going through the card, and that is Boku. What Boku is doing, it's not card payment, it's only on the phone, and the top line is growing sensationally quickly at the moment. Very different to that is Springfield Properties, the number 4 company. It's the largest Scottish house builder, in Scotland. Very good land bank, and as confidence begins to return, we should see we should see a pickup in profitability there. And more buildings, more houses being built, and with that long quality land bank, they will be in a very strong position. Some of the other names you obviously know. Then there's a Cohort, the 9th biggest holding, is a smaller defence company. It's this mix, large, medium, and small, different end markets that will be the strength of HOT going forward. Last slide, please. This is just to show the cheapness of the portfolio. These are growth companies. The price to sales, i.e., the market cap, to the sales is at a very low level at the moment. Though they're growing fast, you're not paying what you usually pay for those sales. And I like this as an indicator of value, because the sales number is a clean number. It's not depreciation doesn't come into it. It's just the sales and adjusted for debt gives you a real feel for the size of the business. So for all we can show that on profits or other ways the market's cheap, but actually this shows clearly that the actual size of businesses are not being replicated in their share prices, and we're beginning to see the early stages of a recovery in those valuations. Actually, there's one more slide to summary, and before any comments and questions, which would be very good. So this is different. This is a mixture for your portfolio of names that of many of the companies that will, we believe, be leading companies of tomorrow. Maybe not that well known today. 42%, around 40% of the portfolio is in AIM. AIM has had its problems, and people are worried, have got their worries on AIM. But that is where the next generation of really good UK companies will emerge from, and it's happening quite fast under the surface. With that, I will stop, and I think we've got 10 minutes for questions, if there are any.
Thanks very much for that, James. Can I just remind delegates, if you'd like to ask a question, just click the Q&A button, which you'll find towards the bottom of your Zoom screen. We've got one question to begin with from Andrew Chollerton, who mentions that he saw a report that you recently purchased a position in surface transforms. They've had some production problems, I think, for a long time with the ceramic brakes that they produce. What are your views on that?
Yes, you're absolutely right. That was very observant. There's been a rescue rights issue and we've participated in that, having had a holding before. But what do I think? I think there is no problem with demand for their product. They've got an extraordinary list of real world-class OEMs, the big names in high-end cars, and their ceramic brake is much in demand. And as you say, there have been production problems with and particularly the fitting out and the commissioning of the new plant. I've visited, and we believe that those problems are now behind them. So the valuation will appear very low if we're right and the company's right, that the majority of those production problems are behind them, and slowly they'll all be behind them. But it is new what they were doing for them. It was scaling up a process, and there often are problems in commissioning new plant when you're breaking ground in a new process. In time, we believe they've learned how to do it, and as I say, the potential sales are there. Now they get to fulfill and supply those sales, and I think it is exciting. Think about a ceramic brake. Why is the sales strong? These new EVs are heavier, and they will wear brakes out more. A ceramic brake is a much higher quality brake than the previous product. So this isn't yet going to be in every day in the medium range cars. It will only be in high range cars to begin with, but in time, with the growth of EV, the requirement for better brakes will become more evident. So it's not just they'll need to build further plant in time if they're going to get further down the market, and that is genuinely exciting. There's one other big ceramic brake maker, a bigger ceramic brake maker on the continent, but this is a UK company that is actually growing really well. It could grow really well in this space. So no, thanks for the question, and a really exciting company. Yes, problems, but often there are on the way to success problems.
I think the key question there is whether the management are up to the job of sorting out those issues and getting their production profitable is, of course, the key. So fingers crossed there.
Yes. There has been some management change. The management that sometimes people that grow companies early on aren't necessarily the people to take them to the next level, and that may have been a little bit of the problem. That they were really good early on, and the technology is exciting. There's now a team to take it to the next level. So. And that's part of the evolution of companies. So thanks for that question. It's a really good one and a really exciting company to be following.
Thanks, James. Next question from Jay. So he's asking about the impact of the new government's housing policies on Springfield in particular, and also if you have any comments on Next 15.
Thanks. On Springfield and the housing market, the government major plank of its policy is to get growth back, and growth and how they're intending to do that. One of their is to see house building in the UK go up, and they're talking about, as you know, 1.5 million houses over the next parliament, which is 300,000, more or less 300,000 a year, which would be a double, almost a doubling of what we did last year, 150,000, 160,000. I think it may be this year that there's over 200,000 houses built in the UK, but it's so it's a marked step up. This would obviously be a huge achievement if it's done. I think with Springfield, there is quite a lot of land in there that has got outline consents. So it could be, it'll be quite one that is quite well placed to step up the number of houses built, because the land bank is quite old. The margin should be quite decent in there, but delivery is always can be an issue. But and affordability is can be an issue if interest rates were to come down and mortgage rates therefore move down a bit, that some of those issues would be solved. And Springfield, as I say, with the land bank they've got, are very well placed in my view. The valuation is very undemanding, both on an NAV basis and a potential PER one.
And Next 15, any thoughts on that?
And Next 15, yes, this is the next sort of generation of advertising company. It's seen a massive derating over the last 18 months. And there has been a slowdown in advertising, but advertising is always cyclical. It does come back, and there are signs that it is coming back at the moment. Therefore, you've got scope for profit upgrades, earnings upgrades at the same time as multiple expansion. So yes, it would very much one that we've been adding to.
Thanks, James. Then Miles asks, the future of hydrogen in the energy transition is being increasingly questioned. Have you modified your views at all?
Yes. I think what sometimes we'll get wrong, we also think there's one answer. I think in the move away from fossil fuel, there isn't one way. There will be a role for hydrogen. There will be a role for small scale nuclear, for instance. I think hydrogen in certain uses will be part of that long-term solution. I don't think, as I say, there's not one winner. There are going to be different uses of different sources of energy. So, for instance, in the use of ammonia as a way of transporting energy is growing. It's already growing. So I think hydrogen is part of that solution, but it takes time. There's a sign that there is traction building. We're seeing more and more long-term contracts being struck with these companies, more and more long-term arrangements of who's going to do what, and hydrogen certainly playing part in that.
Thanks, James. Just I'll slot something in there on that theme. Have you looked at atom energy?
Yeah,
some quite interesting assets, I think.
Yes. No, I thought so. It's definitely on my watch list.
They need to raise a lot of capital to
Somewhere.
get it built out. Yes.
There could be an event sometime.
Yeah, this is true. Thank you. Okay, then moving on. So Jay is asking a more general question. There have been quite a few UK businesses where overseas investors have recognized the lowly valuation, and there have been quite a lot of bids coming in. Any thoughts about the trends there?
Yes, I think it's amusing when to watch colleagues when a bid happens and there's an initial bit of excitement, and then about 10 minutes later they think, goodness, am I really going to lose this company at that valuation?
Yeah,
Uh, so there's
I
this
know
sort
the
of
feeling.
there's that sort of sugar rush on the 40% uplift to yesterday's price, and then the realization that actually the buyer is probably getting the best of the deal on a 10-year, or no, on a 3 or 4 year view probably. I think, overseas people think you take a long time to build some of the market positions they can acquire quite cheaply in the stock market. That said, it is a reminder of the value. It's a verification of of the thesis that the UK is offering value, and always in the cycle, the people that buy at this sort of time are the people that do the good deals, and then there will be people later on in the cycle that pay too much. Um, so so we can't have it always, I suppose.
And then the last question from the audience comes from Andrew. As you mentioned at the start, you run Law Debenture, Lowland, and Hot. Can you just clarify what are the areas of overlap and difference between those trusts?
Yes, Law Debenture is more international. It's got a market cap of over £1 billion. So it's in bigger companies. It's got its own business, the fiduciary services business that produces. It's 20% of the assets. It's 35% of the earnings, and it's a very good quality growing business. So we run lower risk, a lower active share in Law Debenture, and we have a longer list of stocks. We have almost 150 holdings in Law Debenture. So bigger companies, more overseas earnings in there. Lowland is an income fund. It's got the highest yield of everything we do. It's got 48% in larger companies at the moment. The rest is in medium and smaller companies, but they're more yielding medium and smaller companies. There's less of the small growth company, and most things in the portfolio do have a dividend, and its overall fund is yielding 5. Hot is lower yielding, much lower yielding at 3%. And there's this greater emphasis on really small cap growth, particularly on AIM. A lot of these companies don't pay dividends. They won't for quite all, if ever, pay dividends, but they are, believe, the growth companies, the companies of tomorrow down there. So they're very different funds. There's an overlap in some of the big stocks, particularly small cap in Lowland is very different usually different to a small cap in Hot. The Lowland small caps are seeing more bids because there's often more assets involved. If there's less growth but more assets, and there's more cash generation and in a Lowland type company, but less exciting growth. So we do find them different. They are different. The three portfolios very different. The performance has been very different over the last 5 years. Eventually, if you go back further, the performance gets more similar as you go over the long term, because they're in different markets. They perform differently. We believe that the broadening of the market will help a bit in medium and smaller companies. So with Law Debenture, we have been buying a bit more in medium and smaller companies, but it'll never have as much as Lowland or Hot.
Thanks. Then I'll just slot in a final question, as I don't think we have any more from the audience now, which is you spoke about the dividend policy a little bit at the beginning. Is that dividend covered by income, or do you pay it out of capital?
It's covered by income at the moment, but that said, the board said they're going to keep increasing it, and they would, I think, probably use capital if they had to. So where I am is about growing the capital, and then we can have that's what produces the income. Because if you're growing the capital, you've got a bigger pot to produce that income. The other two would Lowland or Lord Adventure would always use genuine income. Hot has got the ability to use capital for that income payment. It's not, but why they're confident in saying the dividend can grow is they know they can do that, and that takes away any strain from me of worrying about income and broadens the number of stocks I can have and how much we can have in early stage companies that aren't paying dividends.
Good, thanks. And then another question's come in from Andrew. He's just asking about how the gearing that you use has evolved over time.
Yes. So the gearing at the moment is about 9% in hot, because we've been 8-9% because we have been reducing some of the bigger stocks but we will be moving it up. We will be a net buyer, particularly in the medium and smaller company area over the next period. If, let's say, the Labour government, the horrible scenario, were to take away change the taxation of individuals for AIM stocks, we'd imagine that day one there would be some weakness, but that would throw up some very exciting opportunities. And in that kind of situation on hot, we would be looking to buy some of those stocks. So I don't know if but there can be some event that can lead to a bit of weakness, and we will be buying for hot and moving the gearing up in that situation. The other two trusts are around 12 or 13% geared at the moment, and again we'll be net buyers and bring them up towards 15 over the summer months on any weakness.
Yeah, so you could increase the gearing if you saw good opportunities.
Yes.
Can I just ask how you implement the gearing? Do you use contracts for difference, or do you have a revolving credit facility? And if so, what's the expiry on that?
We've got revolving credit facilities, and they're a 2-year facility for hot, and it's got another year and a bit to run, I think. We've got no structural gearing in hot. We have in Lord Adventure and Lowland, where we've got a mixture of a revolving credit facility and a long-term fixed borrowings. But it hasn't been a problem renewing the revolving credit facility.
Yeah, your bankers are quite happy to keep lending.
Well, it's the outside and the splits. The banks have never had a bad debt from them, I think, from the quoted investment trust. So they're always quite keen to lend to us.
I would have thought so. Okay, thanks very much for that, James. Very interesting presentation, and thanks for your time in answering those questions as well.
Well, I've enjoyed it. Thank you very much.
Thanks, James.
And any questions anyone has, I'm always keen to talk through the portfolio. So thank you.
Great. Okay, thanks very much.